Hi, Clint Coons here with Anderson Business Advisors, and in this segment, I'm going to talk about how to take money out of your entities, be it a corporation or a limited liability company. Let's face it, as you start making money, the question then becomes, how do I get access to that money? Do I take it out as a salary? Does it come out as a distribution? Does it come out as a loan? All of these questions come to mind. I'm going to show you right now what you need to consider when it comes to taking money out of your business. Let's start with the corporation. Let's assume that you've created a corporation for yourself. Okay, this is a C corporation, or it could be an LLC taxed as a C corp. You are right here. You are an employee of this corporation. So if you have income inside of the corporation, one way you can pull money out is through a salary. Okay, so a salary is active income. So you're going to have to pay employment taxes on any income you pull out as a salary. Now, I strongly suggest that when you're ready to take a salary out of your business, that you set yourself up on payroll, use your bank. Typically, they charge $50 to $60 a month to handle all the payroll reporting for you. I think that's the best way to go, but if you feel comfortable doing it on your own, go right ahead. So salary is one way to take money out of your corporation. Again, it's taxable to you, it's active income, and it's subject to employment taxes. Another way is reimbursement. Okay, so with this, what we're looking to do is pay you back for any of the expenses that you've incurred to date to get your business set up, or anything that you pay going forwards for the benefit of your business. So in order to reimburse yourself, you have to keep a list of all these expenses, keep a tally, and then when your profits come into the corporation, then you'll start reimbursing yourself out. In fact, when we're talking about which way we should take money out of our business, first off, I would start with the reimbursement, number one, then salary. So after you've reimbursed yourself all of your startup expenses and all the expenses you've incurred personally on behalf of your business, then switch to salary. The thing is here, I want to get you paid back before we start creating taxable income, because a reimbursement is not taxable to you, because all you're doing is making yourself whole. You spent the money personally for the benefit of your business. Let's get you that money back as soon as possible. Now, I was recently speaking to someone who thought that they should do this. They said, Clint, I want to reimburse myself as soon as possible for all of my expenses that I've incurred on behalf of my business. So this is what I'm going to do. I'm down here. I'm going to take $60,000 in my own name, fund it into my corporation, pay myself out of reimbursement to turn around and have money to pay my credit card bill. All right. If you're looking at that and you're doing this right now, wondering, why would you do that? That's exactly right. It doesn't make sense. Now, for some people it does, because when you hear this, you think, wow, I got to get the money in to reimburse myself right away so I can pay the credit card bill, because those statements or expenses need to be attributed to the corp. Calm down. It doesn't need to work that way. You can pay that money yourself. Pay your credit card bill for those expenses personally. You do not need to move the money into your corporation just to reimburse yourself. It's still considered to be an expense to the corporation, even though the corporation did not pay it. Meaning this, you paid it on behalf of your business. So you don't need to put money here just to take it right back out at the same time, put it in your own name. No, what you should do is pay your bills on behalf of your business personally. If you don't have any income in your corporation yet, keep track of them. Then when your corporation has income, that's what we're looking for. When it has income from flipping real estate or from managing other assets, that's when you'll start reimbursing yourself. You want to reimburse yourself out of income from that business. All right, so we have talked about salary, we've talked about reimbursement. The other way you can pull money out of your corporation is through a loan. So you can take out a loan. That would be number 3 method in order to pull money out. Now, a loan means just what it sounds. Your corporation will loan you money. But again, you're not going to loan yourself money unless you have profits. Okay, it makes no sense to loan yourself money out of that business until there's profits there. That is, put money into the corp and then loan it back out to yourself. That's just a lot of unnecessary paperwork to put that type of structure together. Another way you can pull money out is through a dividend. Now, with a C corporation, I do not recommend you pay dividends out, because with a C corporation, you're going to be taxed once at the C corporation's tax bracket on your profits. Then when you pay out a dividend, you'll be taxed again. So I'd be very careful on whether or not you ever pay dividends out of this business. Typically, for most people in this position, we are focused on these two right here, reimbursements and salaries. That's how we pull money out of our corporation. Now, That's from a flipping business. How about from a rental business? How do we pull money out of that structure? Well, again, it really depends on how your structure is created. Most people are in this situation right here where they have a holding LLC right here. And this holding LLC will own other LLCs that have property. So this is LLC number one. And I'm not going to put in land trust in those extra boxes right now because it's not important for the purposes of this discussion. This is LLC number two. You, of course, you're down here. Now, the money comes in here. It then flows from this LLC into here, and then from this LLC down to you as you need it. This transfer right here, number one, from here to here, this is called a distribution. Okay, you're not taking salaries. There's no salaries in this structure. From here to here, this payment is called a distribution. All right, they're all called distributions when you're dealing with LLCs that are not treated as corporations. So you're just flowing the money down. But you have to have bank accounts for each of these entities. If you don't have bank accounts for each of these entities, then you won't be able to do this. Do not take money from here and move it down to here with this type of structure. So this is the way you would take money out of your limited liability company if you have rental property. Tenants pay the LLC, and as you notice in the segment where I discussed how the money flows as far as running a rental business with the tenants, watch that segment if you haven't yet to see how the money comes in. But this is how you pull it out. Now, for those of you that have a management corporation set up to manage your rental real estate, that might change things a bit. If you don't want it flowing down to yourself and you've created a management company over here that manages all of these assets, you can always pay a management fee to this company, and then that's just income to the corporation. And if you forgot how to take money out already, just go back to the start of this segment and just watch how to pull money out of your corporation. You remember, it comes out as a salary or a reimbursement from this company. So you have different options. What we're giving you are outlets on how to gain access to your funds. So my name is Clint Coons with Anderson Business Advisors, and this segment was on how to pull money out of your limited liability company or your corporations. Thanks, guys.